Hey YouTube, it's Dimitri, and today I wanted to talk a little bit about why quantitative finance is much harder and not as straightforward as people would like it to be. Also, why you often will probably be looking on the internet and you're like, just tell me how to do A. Like, tell me how to model this. A lot of this is going to come down to the fact of derivative pricing is taught as the Black-Scholes model. You learn the project, you learn the pricing, and everybody thinks that's what we do in practice. And there are cases when you will do that. And there are many cases when you will build custom models and you will deviate and you'll be doing a lot of math and stats to build statistical models. And that includes AI, ML, statistics, mathematics, for example. It includes everything under the sun with this. And so let me break down why this is challenging. And really, this is a data problem, right? This is really what we're getting into here. So we have, imagine let's just pick out a firm here. Let's pick out banks because banks are easiest to start with and understand. And then we'll deviate into the investing realm and why that is different as well. So imagine you have two banks, okay? You have Bank A and you have Bank B. Okay, so let's say Bank A is going to pick some sort of customer base here. So let's say our customer is going to be a prime customer. Their geography, let's just say it's going to be North America, Europe, let's just say that's their geography. And let's say their size of their portfolio, their positions, asset size. I'm just going to call it AUM for assets under management. But really like the balance sheet of this. Let's just say, it's $500 billion. And let's say the products they're going to focus in here are going to be credit card, auto, and mortgage. Okay, now let's switch over to Bank B. Let's say Bank B's customer is going to be subprime. Their geography is going to be 10 West Coast states in the US. Their size is going to be, say, 10 billion. And their products, so again, this is product in both of these cases. And let's say it's just credit card. Okay, so we have two banks, two different sizes, two different geographic locations. The commonality we see here is going to be that they're in the credit card business here. So this should be the same. And you would assume, right, their customers would be the same. And so therefore we could use the same data and we'd get similar models. The problem with this, right, as you're probably noticing here, is the customer's different. So in A here, in Bank A, they have prime customers. These are customers that have full-time jobs. They're rarely unemployed. They have cash saved up in savings, right? A lot of things aren't going to impact them that much. Now, when you look at Bank B here, Bank B is going to have subprime customers. So they're going to be very, very, volatile in payment schedules, defaults, life events. Small economic events probably will shake them a bit more. And again, if you look at the geography of these two here, right, you have one that's predominantly in the United States here with Bank B being on the West Coast. You're going to have some sort of market spending habits, design. There's a whole slew of filters that go through this. And then the size of them is they're only $10 billion. Now, when you go back to A here and you start to look at its North America and Europe, you have different regulatory requirements, different data sets, different data collections. You have credit card, which is what we're going to focus on. We're going to ignore the fact that they're doing auto and mortgage, but you got to realize they're probably pulling data, credit data from these customers, and they can share it across platforms. So if you already have an auto loan or a mortgage with this bank, and now you're going to get a credit card, right? They have extra information on you. The data between these is not going to be the same. So if I said I'm going to get a data set for credit cards and I have two different banks, they're going to be vastly different. Now, there's something else which I've been hinting at and I've been talking about in other videos, and that is going to be the fact that you have servicing bias within banking. So if a bank decides to be more aggressive or less aggressive on collections, even simple things like how they notify the customer. If some bank is huge, I can tell you this, I love Citibank, to be honest with you guys. I've seen a lot of their apps or credit cards. They have a lot of features built in that I just love, like the travel notification, and it pops up and it tells me, hey, we know you have a trip coming up. Don't worry about it. Your credit card's good to go. Because back in the day, I do remember traveling and it was like, oh, my credit card doesn't work. Well, it's, Sunday at 1 p.m. or something, or maybe it's 10 p.m. at night. There's no one at this bank that's going to help me, especially if it's a smaller bank. I have all these issues. They don't know I'm traveling. These are features that will drive customer behavior, because now when I travel, I'm like, screw that small bank. I'm not going to use that card. I don't want to take that risk. and I'm going to be using a different bank's credit card on this, for example. So there are features, process, how you treat customers, how you interact with them that actually impact things like pricing, losses, asset recovery if you're doing like mortgages or auto or, those sorts of things. But even for credit card spending and habits on how you use them, again, now they have all these benefit programs. So this card, gives me 4% cash back on dining in restaurants, but this one gives me 3% back on gas. And so these sorts of things drive consumer behavior, which will drive the models, which will change how the models themselves actually work. So the data itself is different, and because the data is different, you will need different models. So let's do an investing example here for a second as well. But really the takeaway I want you guys to do this is different data has different behavior. And when I say behavior, I'm going to say design, structure, implementations, looking at this from a math and stats perspective, right? The distributions of the variables that you have are going to be different. You might have income in both data sets. The customers are different. The distributions are different. You might be modeling a dependent variable like losses, for example, or recovery rates or interest rates or something else. They might be vastly different based on the practices of the bank and the data that you have. And realistically, all these unique filters that you have like in A and in B here, these are filtering and processing your data and changing and molding the customer's behavior. So even though you're recording, the data, you're not like a godlike being sitting on top watching the world happen. You are interacting with these customers and you are changing the data based on your interactions. So this is a key point here. Now, when we go into the investing side, we can break this down similarly. So let's say we have investing firm X and we have investing firm Y. Now, again, you're going to look at this too. What is the purpose or design of the fund? Let's just say both funds are going to be hedge funds, just to make this simple. So this is a hedge fund and this is a hedge fund. But let's look at different strategies and things that we're going to be looking at here. Let's say this is going to be a long short. So this fund is able to do both buying and selling, shorting, so the short end of a position. You're going to be looking at, let's say this is going to be doing equity, let's say, derivatives or sorts of options. I'm going to put options here to be more specific, and foreign exchange, Forex. And then let's say the assets under management here is going to be, $2 billion. And let's say this is going to be a US based firm. Now, let's say this other hedge fund here is going to be, again, long short. They're going to be running in the options market because they want to avoid a lot of the regulations. Let's say they're doing, real estate, like actual hard real estate in both commercial and residential here, some building projects and whatnot. And let's say they do alternative investments. Let's just say they're running in like crypto, and let's just say they're doing like AI startups. And again, let's say AUM, 25 billion. Let's say, again, let's just say it's a US based firm. Now, again, let's look at the similarities here, right? They're both hedge funds. They're both long short. They both do options. AUM is very, very different. And they're both US firms. So when we're looking at this, what we're saying is that these two here on the AUM are different. And also, these are going to be very different, because the firm on the right seems to be a little bit more adventurous, exciting, but there's a lot more risk here. This is going to be a much higher risk firm, especially when we're starting to look at like crypto, AI startups. I have no idea what they're doing in this space. This could be very high risk. Again, real estate depends where you're at, depends what markets you're in, depends what you're working on. And then again, firm X here seems more traditional, foreign exchange, equities, and options here. Again, size is going to matter. How many investors they have, who the investors are, how it's structured, fees and all that. Now, when you look at this as well, you're going to be thinking about, like, let's say you're trying to pull data for this and you have options data, for example, right? And one thing I have learned, which I did not know, it depends where you're pulling data from. Are you getting data from a nice big data provider who's normalizing your data, or are you going to be getting data directly from the exchanges? But let's say all those data providers normalize it differently. You're going to have different data that you're actually looking at, building on, developing models on. That's going to be an issue. Now, also, when I say options, it's hand wavy, right? What type of options are you going to be looking at, right? There are a lot of different types of options that we could be inside of. You're doing Americans, European types of options here as well. Again, that's going to vary this as well. The risk spectrum. So as I kind of mentioned, like this looked like a high risk fund, and this looked like an average risk fund. this will put different rules and stipulations on what sort of options you could trade if we're just looking at options here. Even if we added an equity or something into here, my guess would be with a fund, just from looking at this sort of options, firm-wide is going to be chasing high-risk returns. They're going to be trading a lot more small positions. You might even have a lot higher leverage in this firm that's going to be allowed because it's free roaming. It seems a little bit more cutting edge. It's trying to get that, alt data, alternative investment strategy. The investors it's bringing in, the strategies it's executing are very, very different than investment firm X, which seems a little bit more traditional, where it's going to have a much, much tighter spread on what they're leveraging, what they're doing, how they're structuring it, and how they're running the business. Again, all of these are filters. So when we end up at the end of the day, we have data. And even if we have the same data, the same process, the same everything, we're going to start to filter things out within our data because we're not going to be looking at, this type of equity or this type of option or, this type of investment. And even if you have the same ones, you might be considering very, very different things. Like maybe one firm's very, very safe and they're looking at, options, let's just say, I don't know, European call or something that's close to the money. When you have firm Y, maybe they have some risk they're hedging with it. Maybe they're just going and taking larger bets and they're getting things that are very, very far out of the money and they're taking a lot more risk on that. Again, depending what you're doing, you're going to filter that data down. And even though you say you have options data or you have European calls and put data, for example, and even if you start narrowing that down, there are a lot of factors and things that are going to be changing that are going to be driving the data. Now, things to look at inside the data, and this is by no means a super conclusive list or anything, but looking at distributions, what does your data look like? And often it's not going to be, a single mode distribution. Might be bimodal, like this one. You might have high kurtosis. You might have, all kinds of different things. Maybe you have some sort of skew within this. But the distribution is a really nice tool to look at features and characteristics of your data. Other things you're going to be looking at are going to be things like serial correlation. So, does your data, and let's just go into data types here, right? This is going to be time series based. And for time series, everything has to be in a specific ordering. The ordering matters. That is why it's a time series. If you have serial correlation, you start to throw out specific types of models. Like you should not be using OLS regression because that violates some of the assumptions behind properly estimating the coefficients within OLS regression. So then you'd start to move on to things that have these baked in, like perhaps like a Remax model or something like that. But these are features and characteristics. And again, we're starting to look at, let's just say we had time series data, that was one. Other types of data that you may be looking at. So you have cross-sectional, then we had time series, then you have panel data. These are kind of the big ones. You might also have pooled, cross-sectional. Anyways, these sorts of things are just very broad general characteristics. Now, as we dive into other issues within data, we're going to get into things like what is the number of variables and the quality of that data. And when I say quality, I'm going to say predictability. Because, for example, you might have data where you have 50 variables and they're super predictive and you can model out of those 50 and come down to a 4-variable model. You also might end up in the credit space and end up having, 3,000 to 4,000 variables. And out of those 3,000 to 4,000 variables, I build a model with 30 variables or 100 variables or 200 variables, depending what type of model structure I build. So again, decision trees, for example, like XGBoost, tend to have a lot more variables and they're trying to find a lot more pockets. Again, those sorts of models, when I start to go into, we're doing decision trees versus, logistic regression or linear regression or time series, quality of the data is a huge thing. And again, data access, alt data, data providers, data vendors, there are a lot of changes and differences in this, how they clean it, how they process it, where they get it, how often they're tracking it. There's a lot of things you just don't know. Like obviously you're not going to find out. They often don't provide this sort of information here. But the quality and the number of variables is something else to consider when you look at model structure and model design. Sometimes you don't have enough predictive information and you have to make a decision and you need a model to do this for some reason. You're going to have to build a model with what you have. So you're going to be, seat of the pants, not stellar model. It's not going to meet a lot of these statistical requirements that we would have in theoretical requirements, but you might have to do it because, you have to do it. Now, other things that are going to impact this as well is like missing data. So, I mean, we can say, well, why do we have missing data? What type of missing data it is? I mean, imagine, for example, like you're measuring like how many credit card transactions somebody has, and somebody has a negative 999. Well, in bureau data, that typically means it's a special value. What does that mean? That means they don't have a credit card, so they don't have transactions. So you don't want to include them as a 0, because it's not that they have 0 transactions, it's that they are non-existent. They just don't have actual credit cards. So there are different types of missing data that kind of fall into this framework as well. Now, again, this falls into data quality, data processing. All of these things are going to impact what type of model you have. And so when you look at firms, we're talking about firm A, firm B, bank A, bank B, whatever, firm X, firm Y. It doesn't matter. When you start to look at these things, the data quality, the data size, the data behavior, and how you interact with this all make a difference. Now, when we looked at the investing case as well, imagine you're a large fund and you're doing market making, or you're a huge investment fund. Let's say you're BlackRock or someone doing some retirement position. You're doing some sort of rebalance, and it is massive. You're going to move and impact the market. So just as in the banking case, when we saw, a bank is interacting with how their customers, which impacts their behavior, which then impacts the results of something that you're modeling. The same can go on the trading, the investing side. If you're moving a large position, what's going to end up happening is you could end up moving or manipulating the market a bit just because you need to get out of a really large position, or you need to get into a large position in itself. So these are all things that you start to run into in practice. And what ends up happening, and what I really want to show from this video, is that there are no cookie cutters. And what I mean by this is there's not like the Black-Scholes one, I think, is what blows everybody out. It drives me insane. But people say like, oh, the model that you use for pricing derivatives is going to be Black-Scholes. And I'm like, well, that's one model, one method, a bunch of assumptions. And most of us agree it's not going to work in practice, especially if you're trying to actually trade off of pricing and look for mispricing. You're going to use the Black-Scholes kind of as a framework. And I think this is where a lot of people get confused. There are a lot of frameworks. So recently my team was building out a model to do loss predictions and pricing, and they were using what's called competing hazards. And what this means is competing hazards is if a customer defaults and loses, the loan, they don't pay it, that's a hazard or a risk on one side. And on the other side of that, you have prepayment, which is they pay too quickly and I don't get all my interest back. You have two risks that are competing. You don't want really either of them to happen, but you have to model these out in practice here. These are going to be frameworks. Now, as I pointed out, right, you're going to pick something up even when in practice. I might pick up a model or something like logistic regression, and we'll do that for loss forecasting. And people say, Dimitri, why are you doing that? There might be multiple things that impact it. One is limited data. Two might be the users might not be real comfortable using machine learning. They might not know how to use the models. They might not know how to manage their risks. Like, for example, ongoing performance monitoring. Even when we're modeling stocks, for example, they might have very different behavior. Again, quality, granularity of the data, quality of the data, all of these things are going to impact and change what model that you might use. And also, the most important thing in economics and econometrics, things change over time. People's behavior are always going to be different. And because of that, we might see like a period where it's like tech stocks are booming, everybody's dumping money into tech. And then there's a tech bubble pop or something happens. Everybody gets out of tech and they're running for different sorts of assets. Now imagine you're going to be modeling these stock prices. You might be using, let's just say, a Cerimax model. It's my favorite type of model. But let's say we use a Cerimax model to model time series. So again, we're going back over here. We're not doing a panel problem. We're not doing pooled cross-sectional. We're cross-sectional. We're doing a time series. So we need to pick a time series based model here. We might dive in and say it has to be a time series model. Now, it could be a vector autoregression model, depending how we set up the structure, the design, the drivers, what we're wanting from that model, what we're trying to predict for that model. And even if we fit some sort of Cerimax model, so let's just say, we have some sort of stock, and this is going to be equal to alpha plus, let's say, beta 1 of stock of t minus, 4. So this is like an autoregressive term. And let's just say we do, beta 2, and we do GDP at time t, and then we do epsilon with the error term. This might change over time because the relationships are going to be somewhat fluxing, changing, and moving. Behaviors are going to change, and let's just imagine that this stock is going to be some sort of tech stock here. again, depending on the environment, depending on the use case, this will all change. And as I've kind of hinted at, the data itself is changing and moving. The relationships, what we're trying to model, is changing and moving. And this is why quantitative finance is so hard. The modeling structures, the models that we use will change depending on the problem. And this is why I think a lot of people are very hesitant to go out there and make a YouTube video or a textbook explaining the exact solution to an exact problem. Because the reality is even in my career, when I've modeled the same problem at the same bank, the data is changing, the relationships are changing. And so I might be using something simple like an OLS model to do time series because I didn't have serial correlation on that problem. And then we made a policy change, we entered a new market, things changed. All of a sudden we have serial correlation. I can no longer use OLS. I have to move to like a Remax model or an LSTM or something like that. These sorts of things was what makes quant finance so hard to talk about, because there's not necessarily a model to do something specific. Okay, and to wrap this video up, I wanted to show you guys just a whole slew of examples, because I don't think we talk about this enough, and I do hope on this channel to do a lot more modeling without the fear of somebody saying, this is not the right model for that problem. Quants really have a big toolbox, right, we're gonna hold, and it's going to be all these textbooks, all these methodologies, all the learning that we end up doing, and really every quant has a different toolbox depending on what you have and haven't learned, because I have not even covered every possible textbook that I even own. There's always more new things to learn here. But let's dive on in here to a few examples with this. Just want to throw them out there. Let's look at like commodity pricing, right? We could price all types of different commodities here. It could be agriculture, like wheat, pork bellies, cotton, coffee, chocolate, for example. There are all types of different commodities, and there's all types of pricing that go into that. Again, drivers, variables, things that would impact that would be weather, right? Weather would be a big thing. Supply and demand of that. The age of plants and trees. So I know that, for example, right now, cocoa prices are through the roof. I know the cocoa trees are aging. They're not, I don't think they have new ones set up that are going to be in production in time, and a whole bunch of issues that impact this, that would impact the modeling of just something like the pricing of cocoa. And then you get into energy markets, which I've been talking to quite a few people on the electricity side of this, which is quite interesting. I will put a tag up here or in the description below with Jonathan Emerick as well. He works in electricity markets, and he has a YouTube channel, and he covers a bunch of quant finance things, and I think he has some great videos as well. But I hope when you go through his videos and look as well, he's doing some derivative pricing, some basic stochastic calculus and all that. Those sorts of things all get modeled differently. Electricity is a very interesting space because electricity does not store. So you have to turn on power plants, and I have an interview with him, which I'll link as well, on, there's a supply and demand, and people are turning on power plants to get enough electricity generated. It's not instant. It has to get turned on and set up, and has to get producing enough energy to meet that demand here. Again, natural gas, crude oil, all those sorts of things get baked into this. Metals, copper, silver, aluminum, gold. How do you price those out? What does the data look like? What are the marketplaces you're modeling for? Is it a global market? Is it a US market? Is it used for manufacturing? Is there a reason? Is there a timing of when you would need to purchase these? So I didn't talk about timing, but sometimes you need a price. You need to purchase something within a specific window. You can't wait for the price to move. You have to get the best deal within a specific time frame. Again, modeling, execution, timing, pricing, and all that plays into this. And then when we dive into like investing, portfolio construction, asset pricing predictions, order sizings, setting up your value at risk. And yes, there are multiple ways to do value at risk. Their expected shortfall. There are a slew of things. I have seen so many poorly done value at risk calculations because people just use a normal distribution. It's a whole thing for another video. You need to go through different processes and statistical methods to get to that. Again, there's trend analysis, momentum analysis people are looking at within their investing positions, trying to see how they impact your investing portfolio, your construction, your trades, and everything. And then you have trading within itself. So you have timing of entry and exit within markets. You have stats arbitrage, diversification, and correlation. So we think about like copula modeling, for example. Let's go back to 2007, 2008. If one mortgage goes bad and 10 mortgages go bad and 1,000 mortgages go bad and 10,000 mortgages go bad, what is the correlation or the momentum across time with those defaulting? Is there an economic driver? If so many go down, is there a reason? Are they correlated? Are you diversified? Should you have, some sort of hedge, some sort of derivative product to do that? Maybe you're selling the derivative or that hedge against that, and that is an issue within itself. That's a whole thing. Whole slew of models that fall into these categories. Again, cost minimization. When you're trading and executing, you might have a great strategy that works stellar. It's spot on. You're hitting exactly what you need to. Maybe you're market making, for example. But your execution, there's too many executions. There's too many buys and sells happening. And the cost of trading there is just going to kill you. So you might have a model that predicts the optimal timing of how many you should be trading. Maybe it's the size, the tick move, looking at order flows. Those sorts of things are going to impact, for example, a cost minimization model. And there's going to be a whole bunch of data behind that. And you can use a bunch of different modeling methodologies to do that. Again, hedging. So I think this is something critical that we often ignore. So you learn derivative pricing and everybody runs away and they say, oh, quants don't do risk management. That's a separate thing. Quant finance is risk management. When you think about things like delta hedging and vega and gamma, and you're looking at all the different interactions with here and theta, for example, with your time, those sorts of things are what you're doing. You're doing some sort of hedge. You're looking at the risks, the deviations from your model, where the model is going to fail, where the assumptions aren't going to work, maybe where the position or the portfolio is going to get imbalanced. This is risk management. This is hedging. Corporations, big corporations that make food, for example, or manufacturing cars. Like we talked about aluminum and steel and copper and all that. If you're doing manufacturing, you're going to be looking at hedges, for example, and purchasing maybe derivative products to hedge the price and lock in pricing that you need to do manufacturing, to purchase those sorts of commodities here to make things happen. Again, I have currencies in the top as well. Currencies impact businesses globally. It is a huge issue, a risk, a model, market making that goes on there. There's a bunch of stuff that will kind of play into that as well. More examples here. So let's just dive into banking. I did CCAR modeling, which was using macroeconomic variables to forecast and predict out how a bank will do through an economic crisis. You're modeling out the balance sheet and the income statement, essentially. So assets, liabilities on one side, and going to be income and expenses on the other side. It's a whole exercise. It's a whole process. It's time series. It's modeling. It's data. Again, you have bank data that you're modeling. So how is your bank's data and behavior going to change with economic changes? Depends how you run the bank. You have CECL modeling, for example, again, which is going to be looking at how we predict out losses, for example, on loans. You can align a lot of these regulatory modelings with internal decision making as well. So it's not just for the sake of regulation, which I hear too many people complain about. These things are used and they should be used in decision making as well. Derivative pricing falls in banking as well. A lot of times banks are going to be the financial engineers that are constructing these sorts of derivative products and selling them off. Loss forecasting, loan pricing, as I talked about as well. Fraud. So loan fraud is looking for fraudulent customers, dealers, institutions, that sort of thing on the loan side. That is very different modeling than credit card fraud. So credit card fraud is looking for transactional data. And then we have operational losses within these firms as well. So what people don't realize is you typically hold extra cash for losses. Part of this goes into the regulatory side. Part of this is realizing, like, if you're running a trading operation, the market might swing, but an operational loss might be somebody frauded you. Somebody was not following their risk management rules and took too big of a position and it went south. We all know all the famous stories about traders that have gone rogue. So again, operational loss is something to consider in there as well. It's a whole modeling framework. We did, I think it was called LDA, loss distribution analysis or approach, loss distribution approach. It's using severity and frequency, and you have to create these, again, distributions and structures, different sorts of data. You have sparsity within data, so you don't have enough data, so you have to gather data typically from other firms. This creates an issue now. Do you run your firm like other firms? And are there security policies and a whole bunch of things that go into this? Will impact how you model this and if this is even a functional type of model or if you should use a different type of model. Again, your data is going to impact the models that you use. And then you have interest rates, forwards, yields, SOFR, all kinds of rates impact loans, borrowing money for firms, cost of capital. Rates impact absolutely everything in finance, and we use time value of money to discount things back to look at even like projections of if a project's going to be profitable and getting like net present value. Rates are critical. Rates are huge. And then you have macroeconomic factors, which I haven't even touched on here. So actually modeling out GDP, LBR, which is unemployment, HPI, which is the house pricing index, CPI, which is inflation, disposable income, VIX, which is volatility. And volatility modeling can get quite complex, and that all goes into derivative pricing as well. So VIX is going to be the stock market. You could be looking at volatility of a specific underlying asset within some sort of derivative. There's all this to model. There is some I haven't even covered in here operational sorts of modelings as well. So for example, at banks and trading firms, there are other sorts of operational models that you would be predicting. For example, in banks, when do you call a customer? How often do you call a customer? When do you repo an asset? Are there legal issues you have to face? How do you face those? There might be modeling that plays into all of these different sorts of parts and pieces here. The takeaway from this video, which I hope you guys have realized here, is there are a lot of things you can model. There are a lot of different types of data and data structure. There are data quality issues as well. All of these bake into the fact that the models that you use in quantitative finance will change depending on the problem, the use case, and the data itself. You have to have different types of models in your tool belt and your toolbox, from statistics, mathematics, machine learning, and AI, to really build out quality models for the use case in a period of time. Now, we all know it's a social science. Finance and economics and markets, they move, they're irrational from time to time. Things seem not to make sense to us, but the market itself has an understanding of what it's doing, pretending the market has at least some sort of underlying understanding, depending on how you view that. But those sorts of models get baked in, and that is why model types change constantly, and that is why you need to know a wide range of tools, and why it is so hard for us to actually nail down exactly like this is how you model this in quantitative finance, because that will change a lot depending on the data, the use case, and a bunch of other factors that bake into that. So anyways, thanks for listening. Thanks for watching. I hope you found this helpful. If you did, don't forget to like, share, and subscribe. And as always, until next time.